is 54 hours of intense, physically demanding training under conditions of sleep and food deprivation. During this time, recruits will be forged in the furnace of shared hardship and tough training that is the time-tried and battle-proven trademark of Marine Corps recruit training. There will be night forced marches, a tough night infiltration movement, a combat resupply event, a casualty evacuation drill, and combat field firing. Here, you can see the recruits going through a combat course with multiple obstacles and situations they could run into on the battlefield. They play the sounds of machine gun fire and explosions to simulate the combat environment. Bugle Sticks 4. Here, the bouts will start with the recruits entering simulated trenches that lead into an enclosed area that represents a machine gun nest. The bouts are controlled by a martial arts instructor that starts and stops the bouts. Each bout is stopped after a set amount of time, or when a properly executed technique is delivered to an opponent.
Stand behind it.
Recruits will encounter unique obstacles, each bearing the name of a heroic Marine from the Corps' illustrious history, which can only be negotiated with teamwork. Once each obstacle is overcome, the drill instructor mentors the recruits, critiques their efforts, and retells the story of the Marine for whom the obstacle was named, bringing to light how that individual exemplified the Marine Corps' core values.
Vigorous gallantry and intrepidity in action against the enemy while serving as Weapons Platoon Sergeant, Company C, 1st Battalion, 2nd Marines, Regimental Combat Team 2. On 23 March, Gunnery Sergeant Jordan's platoon was tasked to conduct the attack north through the city on Assyria to secure a critical bridgehead on the north side of the city.
Honor, courage, commitment. The Crucible is the culminating event in recruit training. And in order to become a Marine, all recruits must complete and pass the entire evaluation. Capping the already tough challenges of the previous 2 days is a 9-mile march with full packs and all of their personal equipment. It is the final event designed to see who has what it takes. At the end of the march, the recruits participate in the Emblem Ceremony. This is the moment when the legacy is handed down. They earn the title Marine, and the newest Marines are presented with the Marine Corps emblem, the eagle, globe, and anchor by their drill instructors.
Congratulations, Boston.
Thanks.
Sorry to cry.
The eagle, globe, and anchor is what sets Marines apart from other branches of service who delineate themselves by occupational specialty or demonstrate allegiance to a specific unit through the wearing of a patch or symbol. The only symbol Marines recognize is the eagle, globe, and anchor. Receiving the emblem signifies that the recruits have earned the title of United States Marine. They will now stand with their instructors as the nation's newest Marines.
Marines, welcome to our Corps.
let's go. Let's get into our PT this morning. All right, we're gonna start our 1 minute PT and get the timer going. Jumper jacks. Run in place. Jumper jacks. Knees. Elbow to knees. Push yourself. Toe touches. Arm turns. Backwards. Forward. Jumping jacks. Run in place. Knees. Let's go. We are done. That was our 1 minute PT. All right, now let's get into our training for the day.
Vice Partner and Director of Investments at PFP Wealth, and the honoured guest, Charlie Burton, founder of Easy Trader. How are you today?
Yeah, very good, thanks. Yeah, pretty good.
Suntanned and everything. Is this something local?
No, I got caught out in the sun last weekend, I think, and a little bit red, but yeah.
Okay, well, let's get on to something which is your speciality, apart from getting a suntan, and that is trading. Trading techniques. I suppose from my perspective, I suppose I like to think that most people can get the basics, but then it really is the mind games which are the problem.
It is, yeah. Anyone can be taught the technical, so to speak, the technical aspects, because that's just something that you can learn, so to speak. What's much harder is to learn the mindset, yes. And I do think that it's something which takes time. It's something that there's no substitute for experience. You can teach people all these mindset tricks, so to speak, but it's still going to take them time to actually develop that themselves.
But why is everything so counterintuitive? Everything which is correct is counterintuitive. Like, you take a profit, you think you never lose money by taking a profit. Yeah. But that's the worst thing you can do.
It's one of the worst adages. Whoever coined that phrase, I think, is awful, because there's no harm in taking a profit. Well, if the profit's only after one pip, so to speak, then it's not. There's a bit of harm in that. Yeah, exactly. I don't know. It is one of the hardest things. It goes against our basic human instinct, doesn't it? And I think we've got some slides to go. But our basic instincts are to fight or flight. And when it comes to the markets, most of the time we want to run away from.
Yeah, I think I heard it was like an American guy sort of saying, we're hot-wired or we're hardwired to lose money. I mean, that's our basic setting in the markets. You've got to like literally do the opposite of whatever your immediate instinct is.
Well, yeah, exactly. Fight or flight, and the immediate reaction a lot of the time is to fly away. And like, as we all know, sometimes those best trades are the ones which look terrible at the time when we're looking at them, and they actually become the best trades that we could possibly take. So yeah, it is an interesting thing.
Sorry to interrupt. I heard a superb quote a while back, which was, "We have cave brains or lizard brains. We have medieval institutions, and we have godlike technology." And that speaks to the same point, that we're not hardwired for successful trading. Yeah. We're hardwired, as you said, to run away, to panic.
Yeah.
Because our threats for most of our evolved history were things like saber-toothed tigers, not markets going against us.
Exactly. And that's why a lot of traders are trying to go down the automation route and trying to automate their trading, because to try and remove themselves psychologically from being there in front of the screens and having to make that decision, whether it be to buy or sell or close a profit.
But they don't even do that. They've got the sort of the blue signal and the red signal, and they start sort of jobbing between which is the good one, which is the bad one. So it's a total disaster, isn't it?
Well, and actually, it's very, very difficult for the average trader to actually automate anyway. There's lots of software out there now that you can use for the average retail trader, but actually it's still quite difficult, I'm sure you know, to actually get a very profitable system over time. Because
do you recommend people just looking at a chart, looking at the screen, looking at the live prices, and the sort of the hard right edge, no frills on the chart, just very simple? Is that something that you would actually?
Well, yeah, I mean, price action is the most important thing you can start with anyway. And I'm a big believer in being a chart reader and being able to read the charts, read the markets. I think that too many people are looking for the easy way out. They're looking for some sort of magical solution, which might be a red and blue, whatever it might be.
Well, maybe that's because of the name of your company.
Let's forget that. We named that years ago.
Right.
We thought it'd be catchy, but yeah, too many people are looking for that easy solution, and the reality is, as we know, it's not that straightforward. What we have to do, and that first point there, is embrace rejection. We have to get used to. We're talking about being hardwired. Get used to taking losses, and yet most people almost can't accept that. If I sat down with
horrible. It sounds horrible. It's like, if I say, I could do a lecture on the market and sort of saying the first thing is be happy with losses. As soon as you say losses, the word loss, I mean, it's like people want to leave the room.
Absolutely. Even if you said to someone, I can give you a strategy which has, I don't know, for argument's sake, a 60% success rate, and they would be happy while sat in this room with you, saying, yeah, okay, I'll be happy with that. As soon as they go through those losers, that's it. Then they start to hesitate and they start to second guess and make all of those decisions, which all of a sudden makes them underperform the strategy. So yes, I'm a big believer that it takes time, and embracing rejection. I'd always say to someone, look, you've got to accept taking losses. Don't get so all encompassed in that one trade that you're taking right now. This one trade you're taking right now is just one trade in the next 1,000 trades. Try to put it in perspective and actually minimize the importance of the very next trade that you're taking. And it's all those sort of little tricks that a trader can take to help at least. It's easy for me to say it. I've been there and we've been there trading for years. But at least if they make some little notes of this sort of thing, then it might actually help them.
All right, so, I mean, the second point there?
Yeah, I said ask yourself lots of questions, which I do on a daily basis. This is really for those traders who jump into a trade and then regret taking it after taking that trade because they shouldn't have taken it in the first place. And I always say to someone, if I take this trade right now and it fails, will I kick myself for taking that trade? It's just like a stopping mechanism just before taking that next trade, because too often people are sat there at their home offices or wherever they might be, clicking away, and they're not really thinking about the consequences of what may happen next. But that arresting mechanism may just stop them from jumping in, because they may say, actually, yes, if that fails, no, actually this setup isn't quite right. I'm just trading on emotion here because this market's flying up and I want a piece of the action. I'm not letting it come to me. And that can help just arrest that and just pull them back in before they're about to go and make a bad decision.
Is there a role for trading, for putting trades on or considering trades after the market's closed? So you're not doing it live, you're doing it with some of the emotion left on the side.
Well, absolutely, but that's more swing trading, and there is an element of less emotion if you're swing trading as opposed to trading live, so to speak, whilst the markets are moving. So there is indeed.
It takes some of the heat out, doesn't it?
Yeah, it does. Yeah, they're still going to. You're right in that they've got more time to make that decision. Whereas if you're intraday trading, then you've got to make that decision in the space of 5-10 minutes, whatever it might be. You can think about it and ponder it a little bit more. You're still going to make those erratical decisions anyway, because people are still going to be irrational when it comes to the markets, but it can help. Yeah, absolutely.
Just, we've got a minute left. What's the most sort of important thing we should take away from this?
Well, let's go to the final one then. It says mentally map out your trades over and over. Don't allow yourself to be shaken off. The markets, as we know, are a great mechanism. They're like a bucking bronco trying to chuck us off constantly, even if we're on the right trend. And what I do over and over again is to ensure that I constantly reanalyze why I took that trade, and I go through all the way up to the big time frames, so the monthly charts and the quarterly charts, all the way up to remind myself why I've got to stay on that trend, because otherwise it's too easy, as we know, to just jump off and take a small profit only to then see the market carry on going higher.
And I mean, that is the thing. I mean, apart from I think the difficulty people have, apart from the losses, they're getting the 2 or 3 losses in a row, which is then they change the strategy, is taking those big wins. And it's just the heat of success, which people seem to be. That's the thing that really makes a difference between being a successful or unsuccessful trader. All the winners have losses. All the winning traders have losses.
Yeah.
But it's the ones who make the big money are the ones who are in dollar yen from 100 and it's now 125. They're in the FTSE, short from 7,000 at 6,600 now. Those are the big trades that people take, or obviously within the day equivalent trades. How do you instill that sort of idea of staying in and just letting the trade do the work?
Well, like I said, you have to reanalyze. You have to keep reminding yourself, go back over analysis. What will happen is if you don't carry on going through that repetition exercise, all that happens is you start off with this view and it becomes narrower and narrower and narrower as you just focus in on the markets. And all of a sudden, the market's just done a nice few 100-point move, but you're actually looking for 1,000 points. And you start seeing all the reasons why you should come out right now because the blinkers are on. You have to keep reminding yourself of that bigger picture and stay with that view.
Okay, well, I'm sure the case continues in terms of trading, never ends. Charlie Burton, founder of Easy Trader, thanks for coming in today. And
all right, hope you got some out of that video there. Just to recap a little bit of my thoughts about that is just, trust your trade all the way through the process. Don't think negative while you're in the trade, and don't regret getting into a trade. If you took a trade, trust it, and believe in your trade setups and keep it going all the way through.
Yeah, that's a habit we got to learn, because that ain't easy sometimes when you watch your money go.
Yeah, exactly.
It happened last night.
Yeah, I feel your pain, and I tell myself all the time, it's just one loss. Keep going, because that one loss,
Yeah.
be like, man, I'm done for a whole year. So don't beat yourself up when you take a loss. Just keep moving. All right, let's get into our lesson for today.
Us individually. If we can improve ourselves, then we ourselves are growing to the point where our success can kind of match that. Our success directly mirrors and correlates with our personal growth. And so that mindset, personal development is a critical part of your success journey. And what I want to focus on today is positivity. Now, a lot of people kind of condemn positivity and they say, it's just kind of up in the night thinking, it's being positive and being kind of flaky and so forth. It really is not just about having an optimistic view of life. It's about how you feel about your life. Okay. And so I want to share this quote with you by Joel Osteen. He says, "You cannot hang out with negative people and expect to live a positive life." You see, each day we hear from people out in the field. We hear from customers, and some of them call us up and they say, "My gosh, this is incredible. We've never seen such powerful concepts. We're winning with trading, where our business is growing, ... right? Very, very positive energy. And then we'll get a call right after from somebody else that says, "Oh man, life's never been worse. Everything is just blowing up in my life in a bad way. My marriage is failing. My business is failing. I might get let off of my job. I can't seem to win a trade no matter what I do. I just don't get any of these concepts," right? And so both of those realities can be accurate. In other words, one person can be succeeding in many ways, and the other person can be experiencing a lot of struggle, a lot of failure in their life. And so how does our attitude towards our life begin to impact those things? And what we have found through working with thousands of people over the years is that our attitude begins to impact how our reality actually turns out. And so it's not just about being a positive person. It's not just about having a good attitude towards things and kind of having a Pollyanna view of life. It really is because having that positive outlook begins to create your future outcomes. They find this in science, in medicine. I'm a doctor, and in oncology, when doctors deal with people who have cancer, they've actually found that those individuals who have a positive attitude towards the outcome of their treatment end up having a more positive outcome. How is that possible? Okay, this is a reality. This is science, and we've seen this over and over again. So this becomes very important. And I want to share the secondary thought. Living a positive life is accomplished not by eliminating the negative from your life, but by managing the negative in your life. You see, accidents, they do happen. Health does fail. Businesses do fail. People will betray you. You are going to lose trades. All of these kind of negative
things will come to your life. There is no way to prevent it. The most positive, wonderful people, look at people like Jesus, right? He had also, I mean, there probably couldn't be a person more positive about people than him. And yet, what happened in his life, all right? He was abused, he was persecuted, he was murdered in the end. I mean, it's, you know, a whole lot of negative things came into his life, but that didn't impact his attitude towards other individuals and his life. And so negative things will come to us, but they don't have to become us. You see, negative has not come to stay. There's an expression that says that it has come to pass. And so we have to choose to be positive. In my own life, without just going into a bunch of personal stuff, I can tell you, I have experienced death. My father died at a young age. I had a child die at a very young age. I have experienced other tragedies in my life. I have children with chronic, long-term, permanent illnesses that they will face the rest of their life. Okay, so each of these kind of quote negative things can come into our life, but it's not so much whether or not they do. It's like that warrior with a shield. The blows of the enemy of our lives will come against us. They're going to try and hit us with the swords. They're going to try and throw the spears at you. They're going to shoot the arrows at you. And each day, all that negativity will have no power over you if you develop a shield. And this isn't just talking about like, well, shut down, you know, close off to the world. We're not talking about that. We're saying, you know what, the negative can come, but my attitude, my positive attitude towards life is so strong that those swords of negativity, those spears of negativity, those arrows cannot pierce my shield and interrupt my outlook on life. And this is very important when it comes to our trading, because losses will happen. The number one reason why people fail with their trading is because their negativity enters into their mind, and they begin to embrace doubt. They begin to embrace the idea that, oh, this is not going to work out for me. I lost a trade. I lost a series of trades. I lost 3 trades in a row. Oh my gosh, I just lost a 4th. You know what? Maybe this isn't for me. They begin to doubt. They allow those negative experiences to become them. You see, those things happen to all of us. Brandon and I have lost money. Matthew Thayer has lost money. Ness has lost money. Go on to any session. People lose money all the time. That's part of the experience. But how we let it impact us determines our destiny, the probability of that destiny becoming a reality. And so the take-home message here is not to suggest that negative experiences will not come into your life, because they will. In fact, I guarantee you that negative things will happen in your life. And that may sound negative, but it's just reality. It's just part of life. If you're going to drive down the street, somebody eventually is going to cut you off. Somebody's going to flip you the bird. Somebody's going to get angry at you. You may go home and your spouse yells at you. You may go home and one of your kids is doing something negative. All sorts of negative things can happen in life. But the only thing that you can control is how you respond to it. And so we have to make the daily choice. The choice, even in every moment when those negative swords and spears and arrows fly at us, that we are going to choose to be positive. What does it really mean to be positive? Positivity means that we believe in a positive outcome. So this speaks to our core belief in what we believe will come regardless of the negative events in our lives. And so with trading, when we consider this, we're basically saying, I believe I can become a successful trader and I can make money with this even though I experience losses from time to time. That is the way we are being positive. We're not just saying my life's great even though I'm getting pummeled here, right? We're saying I believe in the positive outcome. And we're holding on to that independent of the negative experiences that can come. So enormously important to your long-term trade success. Embrace that, envision it, look forward to what your trading goals are. Hold on to those and they will help you endure the times where you will inevitably take some losses. It doesn't matter whether you're using any of the IM services, Go Liberty, Cash Trap, whether you're on the sessions with the educators, whether you're trying to implement every last thing that Brandon and I teach you in our sessions, you're going to experience some losses. Brandon and I experience losses all the time. It's just a normal part of our experience. But anyway, our attitude is to remain positive and to know that long term we will succeed. And so that's our encouragement to you today on that. So let's get into talking about trading specifically and how we can go about identifying our trade entry reasons. As we do so, let's do a quick summary and kind of review of what we talked about this week and then bring this all together. So price moves in waves. We talked about why this is. There's a constant kind of tug of war between buyers and sellers. And as there are more buyers than sellers, price tends to go up. As there's more sellers than buyers, price tends to go down. And so this is what creates that fluctuation in price. And as there are more and more participants, that's what we refer to as market volume. And it creates an increase in volatility. This can be illustrated in this little diagram here. On the left side of our screen, when there's only a few participants, we get very kind of small, erratic candles. A lot of them look like little lines, or what are commonly referred to in the trading world as dojis. And that indicates that there's not a lot of volume or volatility in the market. People mistake and they say volatility means instability or that there's erratic, unpredictable behavior. Not so. High volatility is actually a good thing in trading terms, because what we see on the right side of the screen is actually what volatility looks like. This is erratic movement to the left, random spikes just going, tiny candles to the right. As you get more participants in the market, all of a sudden there's more stability in the market, and these wave patterns are much larger. So that actually creates a good thing for us. We want volatility, we want volume, we want good directional movement. That's what creates our consistent breakout and retest structure and other price patterns that we can count on to make our accurate price direction predictions. Which brings us to our next point, which is, how do we make money in HFX and in trading in general? Ultimately, we're making an accurate price direction prediction. Price can only really go up or go down. Even when we say the market is sideways, it's still going up and down at any given second and minute of the day. And so we make our money by combining an accurate price direction prediction with a time expiration. This concept is important as we talk about our specific trade entry reason, is when do we get in the trade and for how long do we stay in the trade? This impacts if you have the ability to roll over your trades. This also impacts how long of a trade you take in the beginning. And so we're going to talk about that today. So as we make an accurate price direction prediction, plus a good time expiration that coincides with that, that's how we make our money. And so it doesn't matter what broker you're with, ultimately those same two variables are it. And so really it's as simple as that. Get good at identifying price direction, identify a consistent time expiration, know when your rollover rules apply, and then you're going to produce consistent and systematic results. Okay, so our specific trade entry reasons, this is step 3 in our objective trade decision. Our 3 steps are, first, to identify market phase. This is part of identifying price direction, right? So if we can identify that we're in consolidation versus a trending time, we can identify where those locations are, where price is likely either going to turn around and reverse, go in the opposite direction, in other words, or
A little technical glitch here. Give me 1 second. Still no luck here. 1 second. Try something else. Not sure why it's freezing like that.
Know when your rollover rules, then Go Liberty will show you a couple things in there as well today. And in each of these, we have different technical indicators that can confirm, first of all, patients are where price is likely either going to turn around and reverse, go in the opposite direction, in other words, or whether it's going to continue in the direction of the trend. So we have to first identify that market phase. Once we do so, we look at several technical indicators to further confirm that information. We can do this in Cash Trap. We can use it in any of the IM strategies. Within Go Liberty, we'll show you a couple things in there as well today. And in each of these, we have different technical indicators that can confirm, first of all, what phase of the market that we're in, but second of all, our specific location. This is a bus stop, right? A bus is going through town, but in order to get on the bus, you have to know when the bus is stopping, that bus station, right? Because if you see a bus coming by and you go try to jump on the bus, you're going to get run over and killed, right? And so knowing where the bus kind of slows down so that you can get on the bus is important. And in trading terms,
that is wrong. Is on? Yeah. You on there? Yeah, I'm listening. What are they doing? Just waiting for people to get on. Really charge my cards and shit? Huh?
When you guys come on, if you can mute yourselves, that'd be greatly appreciated.
these locations, these market pivot points, become an important location where we can, in a sense, get on that bus and make sure and ride it in the direction that it's now going to go. And so knowing that location is critical. And then we need our final trade entry reason, which will be the focus of today, on when we actually get in the trade. So to do this, let's break this down just a little bit further. All right, here we are right here. Okay, so step one, we're identifying our pivot points in the markets. We're looking at price action and price behavior, breakout and retest. Maybe you draw trend lines, or maybe you're utilizing certain indicators such as the moving average line or a super trend line, or the Ichimoku cloud that you would find within the web slinger strategy, or the Bollinger Bands, which is found in the simple scalper or in Cash Trap, or the parabolic SAR, which is another indicator that is utilized in some of the Go Liberty strategies. So once we have done that, second step, technical indicator confirmations. There are many technical indicators. The good news is you don't need all of them. Many people, when they're first trading, they make the mistake in assuming that more is better. And the reality is it's not. Most technical indicators are suggesting one of two things. They're tracking trend direction, so a moving average line, the Bollinger Bands, the super trend line, drawing a trend line, the Ichimoku cloud. Those are all trend following indicators, and they tend to kind of go in the same direction as the overall trend movement. That's an important part of the picture. But the second type of indicator that is more often than not used is called a oscillator. And more of these momentum oscillators, they track momentum, and they show us different price anomalies, like we discussed earlier this week with divergence and things like that, where things that can show us what price alone cannot show us. In other words, they show us when momentum is decreasing. So if we're in a really strong uptrend, we want to see, well, when is that trend kind of dying off? You see this in NASCAR racing or another race car racing, when that car begins to kind of slow down. It's still moving forward in the forward direction, but as it slows down to turn the corner, it has to push on the brakes. And so these momentum oscillators work kind of like that. They can show us that, hey, they're, even though yes, price is still moving in that upward direction or in that downward direction. That momentum is really slowing and it's about to change directions. So that can give us very early indications of when these trends are changing. Why is that important? Because how do we make money? By predicting price direction. So if the trend has changed, we want to know about that. If we went from an uptrend to a downtrend or from an uptrend to a consolidation zone, we need to know that information. That puts you on the right foot to identifying price direction. And so these momentum oscillators, such as the RSI, the MACD, and the stochastics indicators, each are a different form of if we went from an uptrend to a downtrend or from an uptrend to a consolidation zone, we need to know that information. That puts you on the right foot to identifying price direction. And so these momentum oscillators, such as the RSI, the MACD, and the stochastics indicators, each are a different form of oscillator that can give us an idea for where the momentum and the trend is going. All right. And then our step 3 trade entry reasons, we basically summarize most of the trade entry reasons into these specific categories. We have arrows, which we use very often within Cash Trap itself. You're going to get a different arrow every 5 minutes of the day on every new 5-minute candle. And we'll show you what that looks like. But you don't want to just take every single arrow. Now you can, and Brandon and I actually did this very thing. We took over 100 live trades with real money. We literally just refreshed our screen and took every single arrow that Cash Trap gave us. What we were trying to do is
Internet is not my friend today, everybody, so just bear with me. Not sure what's going on, but it's acting crazy.
To prove both to ourselves, this is when it first came out, we really wanted to know how good is this? How consistent, how reliable are these arrows? If we're doing zero analysis, we're not looking at price direction, price structure, trend direction, nothing. We're literally just going to take every arrow as a pops up. And we're not even going to try and get a good entry. It's like if we see the arrow, boom, we take it. Up arrow, call option. Down arrow, put option. We did that on over 100 trades, and we won approximately 60% of the trades that we placed. And we just did a fixed time, and that's what we did. And so as a base, without any rollovers or anything, a 60% win rate on over 100 trades with zero analysis is actually really, really good. Why is that important? Because ultimately, to make money in HFX, you need at least a 60% win rate. When you get it over that 60% win rate, that means you're starting to be profitable with your trades. And so knowing that if you just took every arrow, you're going to be roughly at break even, that's a good starting point. So, but we need to get to that 70, 80, 90% in order to really start to make some good money with this. And we see those kind of percentages as possible, both in our daily flyers, as well as the overall results, specifically with Matthew Thayer, when he posts his regular results from his live calling out trades on his sessions, where he is utilizing the Cash Trap strategy. He averages well over 80 to 90% on all of his trades over the scope of his sessions. Now, he may have an individual session where maybe he goes 60% or 70%, but overall, over the long haul, we have found that he hovers between 80 and 90% win rate, which is phenomenal. But that shows that there's a little bit of analysis that you want to apply in order to identify which of those arrows you want to take. And so, again, we'll talk about that as well. Confirmation candles, we'll show you that. And so let's just get right into a few of these examples and get into our specific trade entry reasons. All right, so if you go to hourglass.im and click on the Cash Trap strategy, it will bring up this page. And there's a few things you need to understand about this page. Now we have several, looks like it's gonna log us out. There we go. Let's log back in. We have several videos that we put together that are saved in our favorite section that you can actually go and you can learn all about cash trap. There are several different approaches to it, and we've taught
Oh, wow. It's really not liking me now. Okay, hold on, you guys.
predicting price direction. So if the trend has changed, we want to know about that. If we went from an uptrend to a downtrend or from an uptrend to a consolidation zone, we need to know that information. That puts you on the right foot to identifying price direction. And so these momentum oscillators, such as the RSI, the MACD, and the stochastics indicators, each are a different form of oscillator that can give us an idea for where the momentum and the trend is going. All right. And then in our step 3 trade entry reasons, we basically summarize most of the trade entry reasons into these specific categories. We have arrows, which prove both to ourselves. This is when it first came out. We really wanted to know at a fixed time, and that's what we did. And so as a base, without any rollovers or anything, a 60% win rate on over 100 trades with zero analysis is actually really, really good. Why is that important? Because ultimately, to make money in HFX, you need at least a 60% win rate. When you get it over that 60% win rate, that means you're starting to be profitable with your trades. And so knowing that if you just took every arrow, you're going to the results from his live calling out trades on his sessions where he is utilizing the cash trap strategy. he averages well over 80 to 90% on all of his trades over the scope of his sessions. Now, he may have an individual session where maybe he goes 60% or 70%. But overall, over the long haul, we have found that he hovers between 80 and 90% win rate, which is phenomenal. But that shows that there's a little bit of analysis that you want to apply in order to identify which of those arrows you want to take. And so, again, we'll talk about that as well. Confirmation candles, we'll show you that. And so let's just get right into a few of these examples and get into our specific trade entry reasons. All right, so if you go to hourglass.im and click on the cash trap strategy, it will bring up this page. And there's a few things you need to understand about this page. Now, we have several, looks like it's going to log us out. There we go. Let's log back in. We have several videos that we put together that are saved in our favorite section that you can actually go and you can learn all about cash trap. There are several different approaches to it, and we've taught those exact precise rules for how you can best take advantage of cash trap. So refer to those videos for specific training about that. But here's how we basically take trades within cash trap. So here we're looking at the euro to US dollar, and you want to note a few basic things whenever you're using hourglass or any of the IM strategies. First is, what time frame is your chart? For this particular chart, we're on a 5-minute time frame chart. And I'll change this color to where hopefully you can see that a little bit better. So up here in the upper left, you can see we're on a 5-minute time frame chart. That's important because most of the time, as a starting point, when we're placing our trades, we have a 3-candle rule. This is not a hard, fast rule, but this is a starting point for your overall trade strategy, which means that whatever time frame you're on, you want to do the time expiration to be worth 3 of these candles. So if we're on a 5-minute time frame chart, that means we want to take a 15-minute trade. 3 times 5 is 15 minutes. So we're going to take a 15-minute trade based upon this particular time frame. If you see that a trade recommendation and you happen to be looking at a 15-minute time frame chart, then that means you your trade time expiration will be 45 minutes. All right, so that's the length of your trade. Now, in most cases, that's a good basic approach. Now, you might be asking yourself, well, on some of the Go Live trading sessions with DL and with Matt and with all these other educators, I don't see them doing this 3-candle rule. And there's a reason for that. And it's because they typically have the rollover feature on their broker. Not every broker has the rollover feature. And let's explain how that works. Rollover essentially increases the amount of time of your trade as long as your trade is not in the money by the first 2/3 of your trade. So this is essentially how it works. If you place a 3-minute trade and your broker allows you to roll over, typically by the end of the first 2 minutes, that's the first 2/3 approximately of your trade, if your trade has not yet gone, if it's currently not in the direction that you're predicting, so if we predicted a call option and now price is currently below our entry point, that means we're out of the money rather than in the money. So if we're out of the money at that point, we're able to roll over. And there's a couple of different rollover rules. The first is typically it will double the amount of time that they have given you in the first place. If you have a 3-minute trade and we roll over once, that gives us 6 minutes. Now, some of the brokers are changing their rules to where they only give you an additional 30% additional time. So instead of 3 minutes, in that case, you'd get an extra approximately 1 minute of time on the trade. So you'd go from a 3-minute trade to a 4-minute, or either a 3-minute to a 6-minute if they happen to give you the double time. Now, as you do that, though, it will increase your trade position amount by 30%. So if you'd place, say, a $10 trade, that means you're going to increase that trade amount by 30%, which would be $3. So if it was a $100 trade, it'd be by $30. And so each time you roll over, it increases that trade position amount by 30%. So that's increasing your relative risk per trade. So you definitely want to be careful about when you choose to roll over. So, but here's how we go about using cash trap. Again, first, we want to identify what time frame chart we're in. In cash trap specifically, it's typically a 5-minute chart. So we want to be looking for trending times, and we want to be placing 15-minute trades. If you have the rollover feature, yes, you can roll over typically up to 2 times. You can do more than that. The broker doesn't restrict you from doing more than that. But just as a general rule, if you're following the educators, rolling over up to 2 times, if you're getting double the time, would mean that you could take a 3-minute trade and it rolls over once. You get 6 minutes, you roll it over again. Now you've got 12 minutes. So that's basically the 3 candles. It's kind of where the 3 candle rule comes from. So if you don't have a rollover feature, just go with the 3 candle rule. If you do have the rollover, you can opt to choose, say, a 3-minute trade. And if it happens to win in the first 3 minutes, great. If it's not, then roll over up to 2 times to give yourself that additional time for price to move in the direction you're predicting. So that's first thing. Second is which arrows do we want to take? Well, again, the arrows that we take is the step 3 in our overall trade decision. It's not the first step. So like right now, we're seeing a down arrow. We have a number of reasons why we could take this down arrow. But we need to first identify what trend are we in, what trend direction, are we in a trend at all? And do we need to favor arrows in one direction or the other? So in looking at the euro to US dollar, we can look at our price behavior. And if you begin to just track from the left side of your screen, you say, well, price kind of went up, went down, kind of goes up here, down, up, down, up. All right, so what do we learn from some of these pivot points in the market? Well, from this point here, it appears that we had a kind of a breakout to the upside, and then it came down. And sometimes when you're first becoming familiar with this, you can kind of fine tune this process. For example, right now we have kind of this straight line that cut through this pivot here. And so, but by identifying those relevant pivots can help you identify which ones are relevant, which ones essentially are more just kind of noise, if you will, or the smaller little pivots in the market. And so again, if we redraw that on there, you can say, okay, so here's our first kind of pivot point there. Looks like we have a breakout to the upside, and then we have a further breakout. So price is breaking out to the upside here. All right. And so what does this tell us? Well, first, because this is our step 1, we're kind of identifying that we're having these consistent breakouts to the upside, so we're likely in an uptrend. So what does that mean? We want to favor up arrows. Does that mean we just take every up arrow that we see? Not necessarily. We want some further locations. Again, we want to know where is that bus station, because we want to take our 60% win rate and we want to move that up to a 70, 80, 90% win rate. To do that, we need to know where the bus station is at, where price is likely going to move from. So here, if we get a breakout, for example, price is likely to retest. So it comes down. Here, it's right on top of these moving average lines. It's right on top of this price movement. In fact, if we add a little bit more of a definitive line here, this will show a little bit more accurately. Well, let's increase the thickness of that. All right, so there's our line, and I'll change this to blue just so that that shows up a little bit better. Let's shoot that blue. And so price has come down to that level, and then we get a confirmation candle. All right, so we could be looking for an up arrow at, let's get rid of that line there. That one didn't draw very straight, did it? Select that. All right, so in fact, I'm going to grab this tool here. All right. So this blue candle here, let's zoom in so you can see this. This blue candle here becomes a confirmation candle because it's at the location where price has come down to retest. So you see, we've taken our step 1, which is, hey, we're in an uptrend. We just had a breakout. We're likely going to get a retest here. And so, and then our step 3 is I guess you could say our step 2 is utilizing technical indicator confirmation. Price is certainly riding on top of this middle moving average line. Let's get rid of some of these other drawings on here because this gets just a little too busy. In fact, I'm going to shrink down the RSI and stochastics on here so that you can see this a little bit more clearly. So here we have our resistance level. Here we have our confirmation candle, that blue candle right there. That's where we're looking to enter the market. For how long? For 3 candles. We're on a 5-minute time frame chart, so we're doing this for 15 minutes. And as I was noting, price is consistently staying above our middle moving average lines, further confirming that we are in fact in an uptrend. And so we want to look for a call option at that point. Where would we enter specifically? At the close of this blue candle. That is 1 candle in the favor of our trend, so that's where we would enter. We could do that for 3 candles. So you could literally count out the candles, 1, 2, 3. Here's where price would close, and we would win that trade. And so, so now with where price is at currently, do we have a further trade opportunity? Well, price has already kind of moved up. It's coming up to this previous pivot point here. So a couple of things can happen. We may get some rejection off of that level. We could consider a put option. But if we want to favor arrows that are going with the trend, we want to wait for 2 things. One is we need a location similar to this location here where price is going to come down to it, bounce off of that, and cause the price to move up. Now, you could just take each up arrow, but for me personally, I like a high win rate, and so I wait for price to come to a location where I believe the price is going to respond. And so we're either going to get a further retest down to this level before price continues up, or an additional option. Let's drag this down so you can see this a little bit better. Further option is that in the next number of candles, we're going to see a breakout to the upside, in which case we will likely get a retest to this new level. And so we could look for a confirmation candle suggesting that the price would go up at that point. And what would we look for? We're going to look for an up arrow at that location. So you see, we're identifying the trend direction, step 1, location and phase confirmation by these technical indicators, that's step 2. And then our trade entry reason, in this case, could become a confirmation candle. That's just simply 1 candle in favor of the trend. Now that means you're going to have to wait a little bit because each of these candles is 5 minutes. And so, for example, let's see if we can get our date range tool here. So from this point here, even on this breakout at this location here, how long did it take before we had our trade opportunity? So from this candle, and if we drag it over to where our trade opportunity actually closed, it says it was 10 bars or 50 minutes. So in other words, it took an hour from this breakout moment for price to come back down. This is actually good news for you. Now, for some of you may say, I don't want to wait that long between each trade opportunity, and that's fine. There are some other reasons and opportunities in which we can take, and I'll show you how to do that. But if you're following simple price action, you're looking for these breakout retest moments, ultimately you have some time. So look for the setup, look for your confirmations, and look for those opportunities. Now, in addition to all of this, at that moment, in addition to the confirmation candle, we also had further technical indicator confirmation from these 2 momentum oscillators. The first of which is the stochastics indicator, which is this top one here, where we have price, or where we have this plot line breaking up through the green dashed line at that same moment. That's further confirming that we have some new upward movement. So the whole reason why you see the stochastics here and the RSI indicators on here is so that you can utilize that plot line and have that crossover. Now, you won't always get the crossover on both of them, but oftentimes you will get at least one of them to cross over at that moment in the direction of the trend. You also get these crossovers during consolidation phases. You can look for those crossovers at the top and bottom for reversal trades. But that's the basics for how I would go about utilizing cash trap. Is first we identify the trend, wait for a nice breakout to one side or the other, look at that retest moment, look for a confirmation candle and an arrow. And some people might say, well, what if I don't get the arrow? That's okay. The arrow is only one of our many trade entry reasons. It's not the only one we can take. It is one useful one, and especially when people are brand new, that arrow can be very useful at giving you that kind of final confirmation to get in the trade. But a confirmation candle is a little bit more black and white, because if you've accurately identified that location where price is likely going to come to, and then turn around and go in the direction of the trend or something like that, that confirmation candle can be very, very useful. Now let's talk about candlestick patterns. There's a number of candlestick patterns that we can employ regardless of which strategy you're using, whether you're on Cash Trap, whether you're looking at your TradingView chart, whether you're in Go Liberty and you're utilizing simple scalper, pickpocket, or web slinger strategies. There's a couple of things that you can look for to further confirm that price is moving in a given direction. And to illustrate this, I want to show you here some additional reasons in which you could take some trades, okay? And this follows more of a price action behavior. And to illustrate this, I'm going to really shrink this down. In fact, I'm going to do this on TradingView just because I think I can illustrate it a little bit more clearly, just because there's less going on the chart. But this principle definitely applies in Hourglass, okay? And the basic concept is this: price action, which is price's response to itself, it is a very powerful part of our overall trade analysis. And so the concept that I want to introduce you to in regards to candlestick patterns is a break of structure. Now, there's a number of different ways to define this, and so I'm going to apply this in a very specific way in regards to candlestick patterns. The two primary candlestick patterns that I teach are, one is an engulfing candle. An engulfing candle is simply one candle whose body, the colored portion, is larger than the previous opposite candle. So for example, if we were looking here, let's just look for one very simply. Okay, here's one right here. So at this point here, we have what is referred to as a bearish engulfing candle. Bearish refers to the downward direction, and it is a bearish engulfing because the red candle, this red body, is much larger than the entire structure of this previous green candle. So this is a bearish engulfing candle. And a bullish engulfing candle would just be the opposite. It would be a large green candle, such as this one here. Let's show you this one. So this one here is a bullish engulfing candle. We have a small red candle here, and then we have this large green candle whose green body is much larger than the previous. All right. So that is one of the candlestick patterns. Now, in addition to that, I want to talk about this idea of break of structure. During times where the market is really flat, I want to draw your attention to all these candles in this area here. Note that all these candles are quite small, and the wicks kind of stick out at different points, such as this wick here, or this wick here. And when I say sticks out, meaning that it's sticking out above some of these bodies, right? The green portion is the body, or the red portion is the body. The wick is just the little line that sticks out in one direction or the other. And we get these wicks on both sides of the candle. The wicks represent where price has been, and the body represents where price opens and closes during that given amount of time. So we're on a 1 minute time frame chart, which means each of these candles represent 1 minute of time. And so the candle body, for example, just kind of give you a quick example of this. This candle here. So if we're looking at this large green candle, price opened at the base of this candle. It moved all the way up to the very top of this wick, right? And then it closed at the top of the body of that candle. So during that 1 minute of time, it got all the way to the top of the wick, but it closed at the top of the body. And that's why we have a green candle, because price opened here at the base and it closed higher than where it opened. A red candle is simply the opposite. It opens at the top of a red candle and closes at the bottom. And if there is a wick, as we see here, it's a little bit hard to see just because those lines are so small, but ultimately that wick represents where price has been, but ultimately the body is the opening and closing. And so here's what I want to emphasize in terms of break of structure. As we look at all of these candles in this vicinity here, you'll note that oftentimes the body, or you could ask yourself the question, does the body of one candle break the high or low of the previous candle. And that is what we refer to, at least in candlestick patterns, as a break of structure. And so you'll note that if we go candle by candle, I'm really going to zoom in on this to try and illustrate this concept, because this is very, very powerful. All right. It's not going to let me zoom in anymore. All right, so if we start out with this candle, we're going to go candle by candle because I really want to make sure you understand this. We're going to start with this candle here. So if this candle and all the candles to the left we already had, and then this new red candle begins to form, this one here, you'll note that the price went to the top of that wick and to the bottom of the wick there. But you'll note between the body of the candle did not breach the top of this previous body and the previous wick here. Okay, so that's where the top and bottom of this candle is. You'll note that this candle does not breach the top or bottom of these, either the wick or the body. But when we talk about break of structure, I'm mainly talking about the body. This candle, similarly, this green candle here, basically it does breach the top of this candle, but does it close above it? The answer is no. So basically, well, maybe just barely above, but definitely not much. So the candle closes at the top of this green body. So you could say that this breaks the structure of this previous candle, but certainly not by much. But technically, that would be referred to as a break of structure, at least of this specific candle. We're not talking about large, high-level view break of structure, pivot points, and so forth. We're talking about individual candles. Because what this is going to give you is additional trade entry reasons. So as you're looking at a trending time, one of the things you can look for is for one candle to break the structure, meaning it's going to close either above or below the previous candle. So here we have, for example, a true break of structure. So we have, let's delete some of these. We have this pivot point here. We'll kind of zoom back out so you can get a little bit better reference for this. Okay, so we kind of have this pivot point here where price has come down, come up, bounced off that, and then we have a breakout to the upside, right? So we have these two pivot points, this one and this one. And now as this breaks out, our new pivot points become this top one here that it broke out from, and now this bottom one here. And so we're looking at these locations for a potential retest. If we're going to get a breakout, we likely are going to get a retest, but we don't always get a retest, as we didn't here. The price never came back down. So the question is what additional trade entry reasons do we have? And so to further illustrate this, let's look at potential break of structure type of entry reasons. So we know we've got a breakout to the upside. Price retraces back down, indicated by at least one red candle. Red candle because we have a breakout to the upside. So we're assuming that, yes, price is likely going to go into the uptrend direction. So a retracement will be one or more candles in the opposite direction. So we have one red candle. And then we're looking simply for a candle to go in the right direction, combined with what we refer to as a break of structure. So this kind of combines the confirmation candle concept with a break of structure concept. So I'm going to zoom in a little bit further here so that you can hopefully see this. All right, so we have our retracement. Then we get this little doji candle here, which is kind of this flat candle right there. And then here's what's powerful. Look at this green candle here. What do we have? In addition to just being a green candle, you could call that a confirmation candle, and that's great. But in addition to that, we also have a break of candle or a break of structure candle. What that means is that the body of this green candle breaks the top and closes above this candle. What that's telling us is that there is upward price momentum. And so you could place your trade after, so we have a breakout. That's our kind of phase one. We're looking at trend direction. We have a breakout to the upside. So we're assuming we're in an uptrend. Price retraces down. We're looking for either confirmation candle and or a candle that breaks the previous structure of the previous candle. And so in this particular case, that's exactly what we get. And so the top, grab this tool here, the top of this candle is higher and closes higher than this previous candle. So at that moment, you could enter the trade for 3 candles. We have 1, 2, 3 candles. We clearly win that trade. Now, as price is continuing, can we continue to utilize that same approach? And the answer is yes. Now, it doesn't guarantee that every single candle is just going to continue on. Sometimes you'll have a lot of winning streaks. For example, check this out. Check out the power of this just by looking at price structure itself. This green candle, do we have a break of structure? Well, the top of this candle here, not just the body, but the whole candle, the wick, is right there. So do we have a break of structure? Yes, we do. In other words, price pushed up and closed above this previous candle. So we could consider this as an additional trade opportunity. Now, people can develop different strategies. They can say, well, I want to take 1-minute trades, I want to take 3-minute trades. There are different, you can backtest a number of those different options. But ultimately, you definitely, especially in a strong trending time, you can take literally each of these candles a new trade opportunity. So here we have one again. So where's the new candle top? It's at this level. It's not because of the body. We're looking at the body and wick to identify break of structure, right? So for example, if we were looking at this green candle here, the wick came all the way down to that level, right? So a break of structure, if we had a red candle, would have to be below that. We're in an uptrend, so we're not looking for downward put option moves. We're looking for call option moves. But just to make sure that you understand this break of structure concept is that you're looking for the full body and candle when considering that break of structure move. So once again, here's our top of the body of the whole candle, you could say. Does it close above? Yes, it does. So this candle is another break of structure. So you could take another trade. Do we get it on the next one? Yes, we do. Candle closes above this previous entire candle. If this had a wick, for example, if we had a wick that looked kind of like this, see if this will draw this for me. If we had if on that candle, we saw a wick on the top and it went all the way to this point, would this candle be considered break of structure of this previous candle? No, it would not. Why? Because the previous candle's wick would be way up here, and this candle would have closed way down here. You see that? And so in that case, that would not be a break of structure, so that would not be considered price continuation indication. And so, but because this candle doesn't have that wick, then yes, we're saying this candle here is actually breaking above this previous candle. And so that is another potential trade entry reason. We could take that trade. Once again, do we have another break of structure? Yes, we do on that one. What about the next one? Closes above this. Here we've got a wick. Is it above? Yes, it is. It's not by much, but it definitely is still above. And so the trend just continues, and we literally have trade opportunity after trade opportunity. It's a very, very powerful concept. And here's where it really becomes important. All right, so as we continue on, every single one of these candles gave us a trade opportunity simply because we were able to identify market structure. This one, yes, trade opportunity. This one, yes, trade opportunity. Why? Because it closes above this previous entire candle body and including wicks. This one, yes, we get an indication again. Here we have a red candle. So it's not just because it's red, but does this candle break any previous structure? The answer is no. And so that is not a trade opportunity. What about this one here? Not a trade opportunity. What about this one here? This one, yes, we get another indication. So this would be another trade opportunity. And as price starts to move into a bit of a consolidation phase, this is where we're no longer seeing kind of these break of structure moves. And so during strong trending times, you just get these over and over and over again. But you want to be mindful of once price starts kind of moving sideways, as you see here, and no longer breaking that upward move, then you want to be a little bit more leery of those trade opportunities. All right. This can further be confirmed when you apply simple technical indicators such as the RSI, such as the Bollinger Bands, as you're looking in hourglass and cash trap, and that can help you to do that. For example, if we add to our chart here, let's auto this back out. As price starts to move sideways, ultimately, one of the indications that price is moving into consolidation phase is a crossover through the middle moving average line. And do we get that? It happens all the way back over here. So, but during a lot of these candles, we're not getting a lot of those confirmation breakup structure candles. We got a couple of them. For example, so this one was one, but it didn't really break above these bodies. So it broke above this one, but it definitely did not break above these. So it's not really showing that strong upward move. The previous high of any of these candles is not breaking above it. And so we're not really considering that as a continuation move. And so anyway, so as price then consolidates, we're no longer considering those trade opportunities. But a way to kind of weed through some of these, especially if you're brand new, is, and especially if you want to catch some of the stronger trends, is combine this concept. So all of these candles, did they all win? Every single one of them won. All right, that was like 8 trades in a row, right? But a way to kind of look for these similar type of opportunities would be to do this. Look for a price to hug either the top or bottom line of the Bollinger Band. So in this case, we're in an uptrend. We have a breakout to the upside. And so we may have some strong trending time where price is hugging the upper line of the Bollinger Band. But we don't know that that's exactly going to happen. We want to look for those signs, specifically those breakup structure candles. But we can also combine that with our RSI reading. What do we have on the RSI during that entire time? The RSI plot line is above 60%. What does that tell us? That there's upward momentum. Again, we want to trade with the trend. We want to trade with upward momentum. And so with each of these, if you see that the plot line is above the 60% line on an uptrend, and we're seeing it hug these upper lines, boy, that's a beautiful trade opportunity. You could take those literally over and over again and have multiple trade opportunities and not just one per trend, right? So it can be extremely powerful. Now, I recognize we haven't been able to go through all of our trade entry reasons today. We have quite a few different videos where we talk about different trade entry reasons, and we try to cover different angles and aspects of each of these opportunities so that you can really begin to embrace all the different trade entry reasons that are available to you. So we talked about arrows, confirmation candles, and candlestick patterns. We didn't really go over today the key RSI numbers. We have in some of our previous sessions, and we've saved those to our favorites in our channel. So if you want to look in more detail at RSI key numbers, last week we covered that in great detail, as well as plotline crossovers and other price action behaviors and patterns with divergence and so forth. So for today, that's what we're going to cover specifically on these. Hopefully that's helpful to you and can really give you a solid idea for what price is doing and how to take advantage of more trade opportunities. Because we know people want to take advantage of as many opportunities as they can. And again, these principles apply to every time frame chart. Just make sure that when you're placing your trade, that you're taking into consideration the time frame chart that you're on. You're on a 1-minute time frame chart, look at a 3-minute trade. You're on a 5-minute time frame chart, look at a 15-minute trade. And that same rule applies no matter what other time frame you're looking at. But this is very useful because ultimately, if let's just say that you're busy and you just can't look for trades that often, you don't want to follow a 1-minute chart, it moves way too fast, you just can't keep up with it, that's okay. Maybe jump up to the 5-minute or even 15-minute chart. Take an hour-long trade. It's okay. As long as it's moving in the direction that you're predicting, it's, jumping up to the higher time frame charts kind of just puts the market a little bit in slow motion. But that's good for a lot of people because maybe you're busy or maybe this is brand new. And so you need it to slow down so that you can kind of keep track of really what's going on as it's unfolding. So be patient with yourself, and remember, keep a good attitude as you continue on. And as you do so, you're going to have a much higher likelihood of reaching success. We're grateful you guys were on with us.
Okay. That takes care of the training for today. Hope you got some out of today's training video. Very powerful there to look for the breakup structure. I use that a lot in my trading. And you can see here how it's breaking out of the structure right there. And I already got a level of support there. Drag that over to kind of show you. And then I got the red line already there. And you can see some up, down action, and finally a big breakout. So this is what he was saying, that all these wicks here, entry points. Right there, boom, come back down to break the structure, break the structure, it's continuing to go up. So this is real stuff. It does work. You just got to take your time and look for it. Here's another point right here. This is probably just moving sideways a little bit. This is what he was saying. This is not another entry point here. You have a red candle, and now it's like leveling out. So now we got to wait for another break. All right, so there we go, guys. That take care of our training. Again, apply this stuff, what you're learning to your charts every single day, and you will start to develop your own strategy and habits of trading and finding great entry points. All right, so I'll see you guys tomorrow. God bless you. Take care.
All right. Thank you. Have a good day.
You too.